There are still great values on the market if you know where to look. So today I'm going to go through 3 companies that I think are still great values. Their businesses are growing, they're generating really strong cash flow, and they're trading for relatively low price to earnings or price to free cash flow multiples. So as we're seeing multiples expand, particularly in semiconductors and areas of tech, these companies are starting to fall behind from a valuation perspective. That gives investors a lot of upside. And in the meantime, if the market isn't going to value these companies highly, all 3 are starting to buy back stock or pay down debt, returning money to shareholders in one form or another. So I think there's a lot of potential for all 3. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with the first company, and that is Crocs. You're probably familiar with the rubbery shoes that Crocs makes, but you may not be familiar with how strong this company is financially. This chart shows Crocs' free cash flow on a trailing basis since the start of 2021. And I want to put some of these numbers into a little bit of context. Crocs' entire market cap, so the value of the company, as I'm recording, is $7.6 billion. The enterprise value, so that is add in debt, is $9.4 billion. So the enterprise value to free cash flow, so the market cap to free cash flow is about 9 times. That's a really low valuation for any large company, but especially for a company that is actually trending higher. You can see here that when Crocs recently reported earnings, they said that total revenue for 2024 is expected to grow 3 to 5%. Now that's after a little bit of weakness early in the year. That's primarily related to some changes they made at the Hey Dude brand. That was an acquisition made a couple of years ago, and they've changed the way that they are distributing that product. So sales have been down 20 to 25% over the past year, but as we start to lap that drop in sales from a one-time basis, for the full year, you're going to have flat to slightly up sales. The core Crocs brand is going to be up 4 to 6%. Earnings per share expected to be $12.05 to $12.50. So that means Crocs is trading for about 10 times 2024 expected earnings. Now, this isn't a high growth company, but it's a high free cash flow company. They're paying down debt at a really rapid rate. They're starting to buy back stock. And I think if you're looking for a value stock that has a lot of potential to move higher as management focuses on strengthening operations and growing the core business, I think Crocs is going to be really well positioned for the future, starting with that really reasonable valuation. I will be back in just a second with the second stock on this list. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The second company on the list is Dropbox. Dropbox is one of these overlooked companies in the cloud right now, but it's one of the original players in cloud storage. And I think investors are overlooking the fact that the company is steadily growing, steadily returning cash to shareholders, and it's trading at a really, really great valuation. As I'm recording, market cap is $8.3 billion. There is a small amount of debt, but in total, the enterprise value is $8.9 billion, and there's $1.4 billion worth of cash on the balance sheet. But what's really encouraging is how strong the company's cash flow is. You can see from this chart that Dropbox has consistently grown free cash flow over almost the last decade. Now that some of that growth is slowing over the past year, but there's a number of reasons for that. One is the company is reinvesting more money in new products, especially related to artificial intelligence. So Dropbox isn't really known for being an artificial intelligence company, but it sits in a very similar position to a company like Microsoft, where small businesses, medium-sized businesses are going to have a lot of their assets on Dropbox. This is where they're going to be sharing documents both internally and externally. So artificial intelligence can be the kind of tool where you can search through an entire suite of documents. Say, where is that contract from 2016? Find a presentation from 2018. What is all of our sales information from the last 10 years? This is all the kind of information that Dropbox could potentially be providing to their users with the use of artificial intelligence. So there's products like Dash that the company is slowly rolling out. But 2023 was really an investment phase for Dropbox. And still during that phase of investment, the company was growing free cash flow and buying back shares of stock at the exact same time. You can see that shares outstanding have dropped consistently over each of the last 3 years. And this is something that management is going to continue to do as they're generating free cash flow. They're going to keep buying back stock. Now, the other thing the company needs to do is return to growth. And that's one of the reasons that this is a stock that trades for a relatively low multiple, is that investors just don't have a lot of confidence that Dropbox is going to grow. But this is arguably one of the best alternatives to moving all your data to one of the big tech companies like Alphabet or Microsoft. Dropbox owns its own servers, so you're not living in a cloud like AWS, and it's building its own custom tools with things like artificial intelligence, improving the interface that you have within all of your documents in Dropbox. So I think this is a company that's really well positioned. It's not going to be a high growth company, but it doesn't need to be at the current valuation. Right now, shares are trading for a price to earnings multiple of 18. Enterprise value to sales is just 3.6. One of the notes I want to give for sales is Dropbox has said that 80 to 90% of their customers are self-serve. In other words, they're coming to Dropbox and looking for their services. They said these aren't outbound sales calls. So as a percentage of sales, Dropbox spends a lot less on sales and marketing than a lot of its competitors. So that's a real competitive advantage. It is one of the reasons this is a very profitable cloud company. But like I said, that price to free cash flow is about 11 as well. So that's a really good value for investors if you're looking for a company with steady free cash flow. And I think Dropbox is kind of a down and out position in the market with a lot of room to improve in 2024. The third company that I'm going to end with is not a popular one, but that is General Motors. And one of the reasons I think General Motors is in such a good position is no one is investing in new internal combustion engine vehicles. All of the new investment and competition is going on in the electric vehicle space. That's why we're seeing margins decline in electric vehicles. We're seeing companies have to raise money. We're seeing new models introduced all the time. But where is all the cash flow being generated in internal combustion engine vehicles? And that is the best reason to own General Motors today. Let's look at a couple of charts. This is a look at General Motors' free cash flow over the past decade. And you can see that the company has generated positive free cash flow each year in the past decade. So after going through bankruptcy during the financial crisis, this is a company that really turned things around operationally. There's obviously always opportunity to improve, but the company's moving in the right direction. And what are they doing with that cash flow? Well, some of it is being invested in new developments like electric vehicles. And they are still making those investments. They're not necessarily rolling products out quite as quickly as we once thought, but they're building that foundation in electric vehicles. They're also investing in companies like Cruise, but they're also buying back a ton of shares of stock. This is the official numbers and the weighted average shares outstanding for General Motors. But this doesn't actually do the recent buybacks the company made credit. There's only about 1.2 billion shares outstanding at the end of the fourth quarter of 2023. And buybacks are expected to continue at a really rapid rate in 2024. I think we could exit 2024 with only about 1 billion shares outstanding. So at the current share price of about $40 per share, that means this is only about a $40 billion company. A $40 billion company with $22 billion worth of cash on the balance sheet, trading for a price to free cash flow of 4.6, price to earnings multiple right now is 5.4. A lot of investors think that General Motors and on these legacy automakers are in trouble. But I think the reality is the demand for legacy vehicles, especially trucks and SUVs, which is really where General Motors specializes, continues to be really strong. Yes, the industry is eventually going to move to electric vehicles, but we're still at a very low penetration of electric vehicles, especially those bigger vehicles that a lot of people in the Midwest demand. So that means that the cash flow is going to continue. I think the best analogy for General Motors today is really the cigarette business in the late 90s and early 2000s. That was a phenomenal buying opportunity for investors because people thought that cigarettes were going to be a dead business, but they weren't. There was still a lot of demand, despite the fact that volumes declined overall over the next 2 decades. These were still high cash flow businesses when they were buying back stock. That led to tremendous returns for investors who were buying at that time. I think that's going to be the case with things like internal combustion engine vehicles and oil and gasoline that we're going to be consuming for decades to come. So those are the 3 stocks that I think are really great values today. I think they're better businesses than a lot of investors think, and investors are getting a really good price right now. So Crocs, Dropbox, and General Motors. What do you think about those 3? Which one's your favorite? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.